Good evening and welcome to our advanced taxation class for today. And our topic is tax planning, avoidance, and evasion. What do we stand to get from this topic? This topic, we are going to be looking at the purpose of tax planning, what is tax evasion, what is tax avoidance, what are other tax planning issues that we can have, and how to strategize and plan our activities so that we can take advantage of the tax laws that is applicable. All right, so what is tax planning? First of all, what is planning? Planning is thinking ahead of the time, thinking your activities ahead before you execute them. That is planning. So for example, you are planning to write ICANN exam. What are those activities that you'll be doing to show that you are planning to write the exam? One, you would have gotten yourself adequately registered. You would have gotten your materials ready for study. You will be attending classes and you'll be practicing past questions and going over your work to see how you are doing. Then it means you are planning to write the exam and planning to pass that exam. What is tax planning? Tax planning simply means planning ahead of paying your taxes. It means arranging your affairs in advance so that you will pay your correct tax. The main taxes in Nigeria can be classified into two classes known as direct taxes and indirect taxes. What are direct taxes? These are taxes that have an impact on the taxpayer's income, profits, or other gains, meaning that when the impact of what you are paying as tax is affecting your income directly or proportionally, or your profits or your gain, this is direct tax. They are paid also directly by the taxpayer to the tax authority. So two things here. It is charged directly on your income, profit, or gain. I hope you know what is the meaning of income. The meaning of income, profit, or gain. Now, income has to do with whatever comes into you as way of either salary or revenue. If you are a businessman, your revenue, okay, it's your income. Your salary is your income, your take home. What is profit? Profit is just the difference between your income and your expenses. So it can be charged on your income. That's why you call it personal income tax. It can be charged on your profits. So petroleum profits tax. It can be charged on your gains. Gains now, you are not doing business, so to speak, or you are not doing business, you're stuck in trade, but you are making surplus of whatever transaction you did. As in the case of capital gains tax, you dispose of an asset. So this income profits or gains, whatever is charged on them is direct tax. And another thing here is they are paid directly, the taxpayer paid directly to the tax authority. The tax authority could be the FIRS or the State Internal Board of Revenue. Now, the direct taxes are, we have the personal income tax, we have the personal income tax, which is called PIT. Now, this PIT for direct assessment, or which is for businessmen, is called direct assessment. For employees, is called payee. So this is that for personal income tax. This is payable by companies. Then we have the company income tax. Company income tax payable by all other companies except the petroleum industry. Then we have the petroleum profit tax, PPT. This is paid by upstream petroleum company. When we are learning PPT or oil and gas, you know what all this means. Meanwhile, the downstream petroleum are covered in CIT. Then we have the tertiary education tax. Tertiary education tax. Then we also have the capital gains tax. Now, all of these are direct taxes because they have a direct impact on your income, your profits, or your gain. Now, what about indirect taxes? What are indirect taxes? Indirect taxes are taxes that are paid. Just a moment. Sorry. I will need to undo some of these things I just did. Send me work. To undo them because it's not carrying for me. So use this. So we said before that we have personal income tax, which is direct assessment or payee. We have companies income tax. We have petroleum profits tax. We have tertiary education tax and capital gains tax. Now, for indirect taxes, these are taxes imposed on commodities. So the key word here is commodities, professional services, and instruments before they reach the ultimate consumer. And they are paid by them not as taxes, but as part of the selling price of the commodity. So it means that they are not, it's not affecting them, they're not paying it directly, They are paying it indirectly, two ways. One, they are not paying it as though they are paying taxes. They are paying it as though they are buying a commodity, that this is forming part of the selling price. That's one. And they are also not paying it directly to the tax authority. They are paying it through middlemen. Example is when you want to pay for your electricity. For those people in Nigeria who are using an app, not selling or advertising an app here, you have there is a particular app that when you buy electricity, it will charge you VAT. And let's say you want to buy 30,000 naira worth, maybe the VAT might just be maybe 6,000 something, and the electricity might just be maybe 23,000 stuff. So you are paying it. Okay, let's just do a little calculation. Let me just demonstrate it. You want to buy electricity of 30,000. Okay, now you want is what you are going to pay. You end up buying this. You end up buying 27,906 naira 98 kobo as your transaction. Then you end up as VAT 2,093.02. When you add them together, it gives you your 30,000 naira. So you'll be saying, oh, I just bought 30,000 naira worth of electricity. But what you actually bought was about 27,000. But you have paid VAT, but you are paying it not as a separate tax, but as part of the goods that you have purchased. That's why sometimes when you go to a big shop to go and buy, because they're paying VAT and all that, their things used to be costly than someone who is not paying VAT, who is selling just maybe in a small shop or even under a mango tree in Nigeria. For those of us who are used to buying phone accessories on people that are carrying it on carts, who don't have any shop, and you're just moving mobile shop, tend to buy them cheaper because these taxes do not apply. Whereas if you go to a shop that is fully equipped and also, the ambience is good, you're going to be spending more. Another example, apart from the value added tax, is custom duties. So you want to buy a car from abroad and they are going to ship it in. Of course, the shipping fee is going to be included in your cost. Now, the custom duties are also going to be included as the part of the cost of your goods. We also have excise duties relating to import and export, then stamp duties. Let's say you want to register your company with the CAC and you've paid your filing fee, you still need to pay stamp duties. All these are part of the incorporation cost. So you see here that these are indirect. Now, why is it indirect? You are paying not to the tax authority. You are paying to the seller or the vendor that is dealing with you. And the vendor will be the one to remit the tax on your behalf. A simple guide to determining what tax is direct and what tax is indirect is that you need to understand that direct tax, the tax burden is borne directly by the person who is paying the tax. Whereas the indirect tax is borne by the person who the indirect tax is not paid directly to the taxpayer, but is borne by the vendor. The vendor bears the burden of paying the tax, see if he's the one paying it, but the person who consumes have paid the tax, especially that of VAT. That's why we say in VAT, the final consumer is the person who bears the burden. So you can see examples of direct taxes here and examples of indirect tax. Now, tax planning, as we said, is when you arrange your affairs to pay your tax, the correct tax. It involves taking conscious efforts to consider the tax that will be payable by the taxpayer at a future date and how it can be minimized. So it means that you have looked at it and said, these are the taxes I'm going to be paying, let's say in 2025. You've outlined all these taxes that is due for your business or accruable for your business to pay. Then you are going to ask yourself, when are these taxes due? Take, for example, when is VAT due? VAT is due on the 21st day of the month following the month of transaction. So we are already in the month of March 2025. Today happened to be the 12th day of March. All the transactions that were done in February, by the 21st day of March, the VAT elements calculated should have been filed and paid. So when you calculate and know those dates for all the years, then that's a tax planning activity. Then your aim is to minimize. Your aim is to minimize your tax. When you minimize your tax, what does it mean? You minimize your tax, it means that you are not paying more than you are supposed to. You're not paying more than you are supposed to. You are paying nothing more than the minimum. So have you heard of the word minimum tax? Okay, so that's the least you can pay. So if you are trying to, minimize your tax in such a way that you don't pay penalty, because when you pay penalty, you'll be paying the accurate tax, you'll be paying penalty and interest. That means you have increased your tax. All right. It is clear that payment of tax is an outflow from the view of the taxpayer. So sometimes, since it is an outflow from the view of the taxpayer, it is called tax burden. So who bears the burden? The taxpayer. Now, from the view of the taxman, it is an income. So this is an expense. This is income from the tax authority. And that is what is called tax yield. So whatever burden is borne by the taxpayer, the taxman is yielding the dividend. So the amount that can be retained by the businessman is reduced by the tax he has to pay. So let's say, for example, this is your profit before tax. When you make a profit before tax, Normally, this is profit that is supposed to be shared by all taxpayers, by all the shareholders. You now paid tax. What you will be left is profit after tax, meaning that profit after tax is lower than profit before tax. And so whatever you are going to enjoy by way of income or profit has been reduced by the tax. The payment of taxes in any country is regulated by the laws of that country. And there's going to be stiff penalties, which may also include prison terms if you fail to pay the tax. All right. So tax planning involves anticipating a set of circumstances and the identification of opportunities to minimize or defer your tax liability within the ambit of the law. So one, it involves arranging of affairs to ensure that maximum allowance is obtained. Maximum exemptions are obtained. Maximum relief are enjoyed. Now, consideration will be given to the likely effects of tax liability of the timing of fixed asset and disposal. So it means in your tax planning, you will need to time when is the best time to buy an asset. If I buy an asset now, how much capital allowance can I claim? If your business is having a 31st December as its accounting year, if you are to buy your assets November, maybe 31st, and you start using it in December 1, normally you will have claimed initial allowance, right? Full amount. How much annual allowance will you claim for that year? You may only claim 1/12 of that allowance. But if you are to buy it January 1, instead of buying it and using it in December, if you have waited till January, which is just 1 month, and you claim full allowance for that year, it reduces your tax. So you might choose to, okay, should I wait for 1 more month and pay and claim full allowance, capital allowance, or should I, the timing, when will you dispose of your assets? The timing of disposal is also important. Then we also have the choice of accounting date of business entity. So when will you want to choose which accounting date will you choose? Do you choose an accounting date that, there are some accounting dates when you are starting your business that will affect your assessable profit and your taxable profit. When we are considering the old tax regime, there are some accounting dates you will choose that the 3 years, the first 3 years will be using one period. We have solved a question like that. Okay, so when you are choosing your accounting dates, it can have an effect. Even when you are changing your accounting date, change of accounting date can also have an effect on how much tax you are going to pay. When we are doing change of accounting dates, we saw that the tax people will likely choose a date that for the 3 months you are going to be paying a higher tax. So let's say, for example, you have a choice of 3 dates to change to. you need to test and find out which of them will not produce a higher tax and choose that date. Right, so that's it. Then we also have the impact of commencement rule. We've talked about commencement rule, change of accounting dates. Okay, then we also have planning with regards to the time that profit is earned and the time of the payment of the applicable tax on such profits. So when the profit is earned, it's earned at a particular time, and when the tax is being paid. Also, cessation date. When you decide to cease your business, can have an impact on your business. You can also choose other things that can, reduce your tax, taking advantage of the tax loopholes. So we said that anything that will reduce your tax, can you remember some of them? We have roll over relief when we are doing CGT. So when we have full rollover, that's a tax planning strategy. Then we have pioneer legislation. So you are not paying tax for 3 years, full 3 years. This is just to mention about 2 that we have learned in recent times. Now, what are some of the tax planning checklists that you may want to use? So if you want to plan to reduce your tax, it's helpful to have a checklist so that as you are ticking the boxes, you know that everything is going according to plan. First of all, in your list, you have a list of approved taxes and levies. So what are the approved taxes you are supposed to pay for this year, for this quarter, for this month, both the federal, the state, the local government? Then there is the timing of fixed asset acquisition. Mention that. The timing of the disposal, the timing of capital allowances to be claimed. Now, we can also hire an asset as opposed to outrightly purchase. Now, let's see about that. When we are talking about capital allowances, we talked about hire purchase, and we spoke about something called substance over form, right? Now, when you are using capital allowances, when you are doing capital hire purchase, the asset is eventually yours. You are claiming capital allowance on those assets, like we calculated, right? We claim capital allowance on them. We are also the higher charge. Normally the capital allowances is the capital element part that we use in calculating the capital allowance. Those interest parts are also allowable expenses. And so you are claiming capital allowance on that asset, you're also claiming higher purchase charges as allowable expenses. If you have outrightly purchased, you'll be investing too much on an asset at one time. If you're not cash strong, might affect your liquidity. You're also going to be claiming only capital allowances. Then you will not enjoy the higher purchase charges that, although you're going to be paying more, but it's also going to write off on your allowable to be a part of your allowable expenses will be written off against your accessible income. Where to invest is also important. You may want to invest in a preferred sector where you get preference, pioneer status. You may want to go to free trade zone and all that. Where to invest? You could also invest in government bonds. Making specific instead of general provisions. Now, specific provisions are allowable expenses. When you make specific bad debts instead of general bad debts, it's an allowable expenses. Payee properly deducted. If your payee is properly deducted, you will not be penalized having to pay penalties and interest. Withholding tax properly deducted. Of course, we have critical dates. Date for filing tax returns. If you miss this date, you are paying penalty. Filing of objection. What we learned about objection, we said 30 days from the date of receipt of the notice of assessment, file objection, and if there is a NORA, you file notice of refusal, yes, file objection to the tax tribunal, tax appeal tribunal. Then pay monthly remittances. What are the dates to pay your remittances? Pay end of year returns and final payments. What it means here is that January, February, March, because payee is on actual year basis. So that of January is paid in February, that of February is paid in March. When it gets to November, that of October is paid in November, and that of November is paid when? December. When is that of December paid? In January. So in January, that's why Lagos State will tell you January 31st, you need to pay your end of year returns. File your end of year returns and final payment. You need to pay that at the end of January. Then withholding taxes, remittances to revenue. You have to pay those remittances on or before the 21st day of the following month. The same thing with VAT. These are indirect taxes which should go to the government as at the due date. Then the Nigerian Social Insurance Trust Fund, I think it's 1%. 1%. Okay. Then the National Housing Fund, NHF is at, I think it's 2.5% of basic. Then we have the capital gains tax. We see consider rollover relief. Then capital gains tax, we said stocks and shares are exempted from CGT. Then we also say pioneer companies. That's fine. Rural investment allowance. You saw when we are doing capital allowance, you have these ones are being reduced. It's being granted to reduce your tax. Investment tax credit, you'll see that in petroleum profit tax. Export processing zone allowance, all these are there. Export free zone exempt profit from of solid mineral. Some of these ones will get to find them out. Then, did we say when you are merger and acquisition? Remember merger and acquisition? If you give share for share, you avoid the capital gains tax. Then consider exempt income and profits. So some income that are exempt from tax, like dividend income, scored frank investment income, those ones are exempt from tax. Then investment option that are low low tax or no tax at all. Dividend distributed out of franked investment income. Then employees' remuneration structuring. Consider the effects of benefits in kind. So sometimes when you are giving benefits in kinds, there are some benefits in kinds that are allowable, that is of no consequence to the taxpayer. For example, if you provide lunch for the staff, everybody and you have a lunch seat, I think that is allowable. You have um, passage rights, okay, allowable expenses, okay. And do you know that sometimes when you give somebody a car, a company car, that's a benefit in kind. Do you know that 5% of that value of the car is seen as income in the hands of the person who is enjoying it? So what kind of car are you giving to somebody? Is it something that 5% of it, when taken as income in his hands and is taxable? You know, these are benefits in kind that you are enjoying. You are not getting it in real cash. But the tax will be taken from your liquid cash and your take-home pay will be small. So how big is your take-home pay? How big is your benefit in kind? So you need to consider that, pension and all that. So even people who are in employment, the expatriates and all that, they structure their activities in such a way that they are not resident in Nigeria for 183 days. So it means that for more than 6 months, they'll be away from Nigeria. And so they can plan their activity to stay like 5 months, scattered here and there. Maybe they will stay from January and February, 2 months. Will come again, stay June and July, 2 months. Then maybe November and part of December. And as they're doing it that way, the times they're not going to be around there, a lot of their expatriates is doing the same job and they're back in their country, and these other ones are the ones earning the income. So they're just earning income for like 6 months, but they're not in Nigeria for 6 months. The other person is earning 6 months. So 1 year, they are paying the money to the expatriates, but not to one person. And they avoid payment of tax in Nigeria. So these are loopholes that can be explored. All right. What is tax evasion? Tax evasion. When somebody is evading, the person is dodging. Somebody will say, why are you evading the question? Means, why are you dodging the question? You are refusing to answer the question. Maybe you are answering in such a way that you're not going straight to the point. Tax evasion. This is avoiding to pay tax. Avoiding to pay tax in an illegal way, in a fraudulent way. So how do people avoid paying tax in an illegal way? We'll be telling you about that in a moment. All right. tax evasion, how is it being done? Let's look at examples of how tax evasions can be perpetrated. One of them is by understating your income. How do we do it? Sometimes you may have 2 or 3 bank accounts, but you're only disclosing just one. So you are enjoying the profit by yourself. You are only disclosing one bank statement. Perhaps that could be the largest bank statement that you have. But there are other ones that are smaller that other monies go to. Or sometimes, you get business income from your personal account and you don't disclose them in your business. That's understating of income. So you are now stating that your income is so and so and can be evidenced by your bank statement. But you have 3 bank accounts, you're only showing one, and the income matches. The ones you have refused to show is a form of evasion. You have stated your income. Then overstating your expenditure. So just as you are understating your income so that you will not pay too much tax, you overstate expenditure. You inflate it. Some people will buy something for 2,000 naira and they will present it as 10,000 naira. That's overstating expenditure. So it means that if that expenditure that you have overstated is an allowable expenditure, it means the amount of money that will be deducted before you pay your tax will be high. So most of this overstating of expenditure has to do with padding allowable expenditures. Travel, transportation. Of course, now transportation may not be overstated because you may need to show proof. For example, if you have flight tickets, but sometimes some people will take advantage of those ones that are not receipted in local travels. But sometimes people want to prefer to book all these Uber, Bolt that have verifiable receipts so that they do not overstate their expenditure. But sometimes there are other things that could be hidden where you can overstate your expenditure. And so the tax authorities have been trained to know where some of these expenditures could be overstated. And so they will ask you for evidence of those things. Then making false claims for allowance and reliefs. So you may want to claim capital allowance for assets that you do not possess. You may have assets that is not yours. You are claiming capital allowance for it. Relief also is part of it. Also, generally allowances and reliefs, making false claim. Then omission of chargeable income for tax returns. So this is relatable to understating your income. You omit an income from tax returns. Normally, you are supposed to disclose income from all sources, but you mention only 3. Maybe you have 5 income source, you only mention 3. You omit certain income, and they are supposed to be chargeable. You omit them. This is tax evasion. Now, tax evasion is usually more prevalent in a tax system that is perceived to be unfair. The lack of transparency in governance may also encourage tax evasion. So generally in Nigeria, people will think that the tax system is not fair. How can I be working and be paying a whole 30% to government? My business needs expansion. Now government have reduced it to 20%. Some will want to, reduce their income so that they will not fall into the 25 million naira bracket and they will not pay tax. Why? Because they perceive the tax system is unfair. And they even say that governance is not transparent. If they pay this money, it's going to the coffers of the government workers or the tax people. And what are government using our monies to do? And so, because they're not seeing something tangible, they may want to evade tax. The Revenue Service views all tax evasion as serious offense, and they will do everything to bring someone to justice. So tax evasion is a serious offense that attracts fines, penalties, and imprisonment. Now, what is tax avoidance? Tax avoidance is not illegal. It's not illegal. That means it's equal to legal. When you are avoiding, let's say somebody is saying, I'm avoiding trouble. It means you don't look for trouble. If trouble is coming, you are foreseeing trouble, you make your way so that it doesn't meets you. Tax avoidance. When a taxpayer arranges his affairs in such a way that he will avoid paying certain taxes, or he will pay the least amount of tax possible, but in a legal way. For example, if you want to avoid VAT, you avoid buying vatable products. So you can't be, okay, if you want to avoid paying VAT, you may not want to go and buy food from processed foods from maybe an eatery. The same fish that you are supposed to buy in the market that is without VAT. Maybe you go to my 12 market in Lagos to buy fish, iced fish, fresh fish without VAT. You take it home and cook. You go to a restaurant and this catfish is being prepared, it's being spiced, and you are paying far more. So you have paid VAT inside it because it is value added that was given to you. So if you want to avoid paying of VAT, avoid vatable products. Apart from boycotting the goods and services, tax avoidance schemes are carried out after a critical review of the tax laws. So you see here that tax avoidance is you are avoiding to pay more taxes. So we could say that tax avoidance is also linked to tax planning. When you plan to reduce your income, your vatable income, we also plan to increase your capital allowances claimable. That's tax avoidance. When you plan to take advantage of pioneer status, that's tax planning, and that's tax avoidance. You will not be paying taxes. When you plan to, invest in rural investment, and you get rural allowances. Rural allowances, that's tax avoidance, because these are going to be used to reduce your taxes. So you see, tax avoidance, you use the loophole of the tax law. Now, some people who decided to register to commence business, maybe they have their business registered or incorporated in 2019 or perhaps 2018, and did not commence business until 2020. They now fall into the new tax law. That's another form of tax avoidance. And that is what Go-Getter Professional Consult did. Started business effectively January 1, 2020. And so it falls under the new tax regime. And you are not going to be bothered about having one income being charged 3 times following the old tax regime. And so that's tax avoidance. Right? So, to the extent that no tax law will be contravened in several tax avoidance schemes, tax avoidance is legal. So, but there are tax avoidance scheme that is being done, aggressive tax avoidance scheme that is being done, and sometimes you will not see the line. It is blurring the line between tax avoidance and tax evasion. Now, look at it now. Tax avoidance can be lacking to, I used to say it's be lacking to a mouse coming into the house, avoid being caught, and he gain access to all the goodies in the house. And you now discover that the mouse is coming through a particular place. You now want to block that part. So that means you have done anti-avoidance scheme. You have put anti-avoidance legislation to block that hole. The rat might decide to look for another alternative route. It could mean breaking a wall to enter. It could mean biting a pipe to come in. There must be a hole for the mouse to come in and avoid tax. So, as the government is noticing these tax holes, loopholes, they are blocking them with anti-avoidance legislation. And that is how the taxpayer will be looking for more. Let's look at the anti-avoidance tax legislation. There are 2 possible forms of anti-avoidance legislation. We have specific legislation and we have general legislation. Now, specific legislation is used to block a specific tax avoidance scheme. It's just like a mouse. You know that there is a particular hole that this mouse is coming. You block that hole, and it goes to dig another hole again. You block that. These are specific legislation to block any avoidance. Whereas the general is done to block all known holes. So you have a mouse problem in your house, and you decided to block all, you just decided to, cement your house again, everything. You now do a general overhaul and block every hole. So that's what general anti-avoidance does. What are the advantages and disadvantages of these? Let's look at specific anti-avoidance. So when you are blocking a specific tax loophole with a specific legislation, it has an advantage. Its provision makes the law imposing tax clear and certain. So when you are trying to block a certain legislation, a certain loophole, you make it clear. Let's say, for example, in the old regime, sometimes the income from the first and second year is being taxed twice or even 3 times. So if you make a profit in any of these years, it's going to be taxed. But what about if you make a loss? If you make a loss, sometimes the loss are being taken twice. But, you know, they now put a legislation that your loss cannot be more than the actual loss. Remember, a loss relief. And because you don't make any profits, you will not be taxed twice. You will not even be taxed at all for those 3 years. So it may just be as a result of just looking out for a strategic time to start your business, a strategic date to put your account year end. And that one income or 2 income may be charged more than once. But if you make a loss in that period, you have done an anti-avoidance. But in this new law, we now look at taxes being charged on preceding year basis. Unlike the old law that you will see some actual year basis coming into play. So because the new law favors only preceding year basis, that has been blocked. And, you know, the right of election also is no longer in place. Now, because there is a specific instruction on that, provision on that, the transaction is clear and is certain. So we know that all taxes for companies are to be charged on preceding year basis. Second one is ineffective or inadequate legislation can be readily amended. So when there is a specific legislation, for example, VAT, you know, at a point, people were saying that the VAT predates the Nigerian constitution and it is not in our constitution. And so equates at 5% then it was not effective. You can also make amendments to the VAT law, make it more effective. Remember 2019, or is it 2020, the VAT law was changed and 7.5 was used. Proposal is underway to make it increase further. Okay, so what are some of the disadvantages? One of them is there is a potential to make a complex legislation more complicated and less comprehensible to taxpayers. Say, for example, the VAT. You try to make people pay more VAT because you think that the rich are avoiding the VAT, the poor are paying more than their fair share, and they now make some legislation and it makes it complex because you're trying to address that blockage, that loophole. You now make a complex situation more complicated. Now, second disadvantage is that as you are blocking one, taxpayers will seek further loopholes and exploit it. So you are trying to block a mouse from coming through the west, it will go through the south. What about general anti-avoidance? Now, advantage is that it is done once and it reduces the legislation is reduced. The anti-avoidance legislation is reduced because you are making a general legislation and not specific. And so that legislation covers a broad range of items. And so it reduces the need for you to provide legislation for every item. Secondly, provisions exist in the tax legislation to discourage all future tax avoidance. So as you are making those provisions, you are also making a provision to mitigate or maybe to forestall future tax avoidance and to discourage them. Disadvantage, they are too general, they are too vague, they lack precision. Some situations might come up and you'll be wondering, does this apply to this situation? It doesn't or it does. And so that's where you see some people start calling and say, what if, look at this situation, what will happen? What is the tax implication of it? Because you don't know how it's going to be applied. It's too vague that you need to consider individually whether certain things applies. Now, too much reliance is placed on the discretion of tax officials for the application. And the tax officials could exceed the intention of the legislation and carry out it in full in others. So in some, they might not carry it out in full, in others, they might carry out in full. Right. Now, tax avoidance and tax evasion compared. This is important. Tax avoidance is legal, evasion is illegal. Tax avoidance is achieved through exploiting the loopholes in the tax laws, whereas evasion is exploited through deceit and fraud. Tax avoidance results in reducing the tax, paying the minimum tax, whereas tax evasion results in paying incorrect tax through the breaking of law. Tax evasion is supported by, tax avoidance is supported by courts on decided cases, and it's not criminal liability. Whereas tax evasion is not supported by courts, and it's a criminal offense because the offender could be charged to court for criminal offenses with taxes. When stretched to the limit, tax avoidance could be disregarded. In tax evasion, any limit to stretch it is frowned at. In tax avoidance, there will be no prior year assessment and there will not be investigation. But in tax evasion, there's surely going to be an investigation and it may go beyond the statutory 6 years. Now, there are other types of issues that will occur as a result of tax planning, tax avoidance, tax evasion. One of them is called thin capitalization. Thin capitalization. What is thin? When something is not fat, it's thin. What is capitalization? Capitalization is providing capital for your business. And how do you provide capital for your business? It's either by equity, the owner's equity. Owners will contribute money for the business, raise money by cash for the business. Then it could be by debts. It means they will borrow money from venture capitals, individuals, and others. So it's either you are taking it from owner's equity or from debt. All right. Now, thin capitalization is a result when the capital that makes up your capitalization has more portion of debt than equity. So you see, how do we measure debt and equity? By using something called the gearing ratio. The gearing ratio. The higher that ratio, the higher your debt. Because your gearing ratio could be debt over total debt, or it could be debt over equity. So the higher the debt, the higher the gearing. Now, when your company is highly geared too much, there are two problems it creates. One, the supplier have a risk of not getting their money because you have taken more and more risk and taking more and more capital. And so it's just like saying that you buy something on credit. You keep taking on credit for every day. There is a high chance that you might take too much credit and you may not be able to pay. So sometimes people will tell you, lend out money that you can lose if it is not paid back. So one of the problems here is creditors bear the solvency risk of the company. So you bear the risk of your capital not being paid back to you. So because you have given somebody too much capital, the percentage of his own money versus what he's getting from you is small. So it means the equity contribution is thin, whereas the debt contribution is fat. So equity contribution, thin capitalization. Now, another problem it faces for the authorities is that the cost of debt is an allowable deduction. Cost of debt is an allowable deduction. So it means that that interest you are paying as a result of debt is going to be allowable. So imagine that you have an income and you have huge capital, you have a huge interest rate to pay. The interest rates will be treated as allowable expenses, and your capital, your income, eventual income will be very much reduced. And so it means less tax burden on the taxpayer, less tax yield for the authority. And if this were to be an international company, then that's a serious problem, because it means that high interest rates may be going from Nigeria to another country, which will form income for that country. Now, imagine giving out a huge interest rate for that item, let's say 40%, and the debt, or maybe let's say 60% capital, and your interest rate is 60% of what you contributed, going as interest to another country, it will be revenue for the country. And let's say the country is not paying more than 5 or 10% tax. You're going to be paying less tax here. You're going to be paying less tax here. And it deprives the Nigerian government the rightful enjoyment of your tax. So those things are here, those things I explained are in credit risk and tax issues. Tax havens. A tax haven is a state or country where certain taxes are levied at a low rate or none at all. So some people move their head office to tax havens and they enjoy tax preference. There's that enjoy tax shield, and they are enjoying the low tax. So these are tax havens. Okay, so in those tax havens, the Organization for Economic Cooperation and Development, OECD, has identified how they will deal with tax havens. So look at some of the factors that characterizes a tax haven. They have nil or nominal or only nominal taxes. Also, they don't provide information about their citizens. Thirdly, lack of transparency. So these are the things that are characteristics of a tax haven. So these are just examples. I want you to go through these examples at your own time. But if you look at these examples, these are examples of tax haven here from Jersey down to Puerto Rico. So right, we have foreign direct investments. Foreign direct investment has to do with directly owning businesses in foreign country. So it means that you have a percentage amount of shares in another country. You have controlling ownership of, let's say, 60% or 50% or 51% or even 90 or even 100% of a foreign company. That is a foreign direct assessment. So there are incentives that are available to people who are engaging in foreign direct investments. And so you need to read them up here. Then there is no tax factors. The no tax factors. So once an investor has determined his business structure, the investor engages in identifying a jurisdiction with the infrastructure that will optimally attain its objective, such that he will be tax shielded, not paying tax at all, or enjoy minimum tax. So non-tax factor sometimes can be considered, even where tax factors are considered in certain companies. Non-tax factor need to be considered, but sometimes they cannot be determined, but they are very important as they hold the key to the success of the investment that is undertaken. So advice on tax planning activities and strategies. Tax planning is the analysis and arrangement of a person's financial situation to minimize tax and maximize its tax relief in a legal manner. Okay? There are ways tax planning opportunities for company and corporations come about regardless of their income or the jurisdiction where they work on. So we have come to the end of today's class. What we've basically looked at here is tax planning. It's important. Tax planning. It includes arranging your affairs, arranging your financial statements, getting checklist. The checklist is the biggest tool for tax planning. So you tick all the boxes and you're good to go. We learned about tax avoidance and how specific legislation are done to mitigate tax avoidance schemes that are personal. Then we have the general tax avoidance scheme. And all of these are giving rise to the fact that tax avoidance is a legal way of avoiding taxes. We also learned about tax evasion, which is a legal way, which we must avoid by all means. Then we talked about thing capitalization, and that was one of the major things we discussed and we stopped so far. So this is the end of today's class. If you have any question, please let me know from the chat box, or you can unmute and talk at this time. Okay. I am not seeing any question. I'm not seeing anybody talking, asking questions. So I will, at this point, call it a night for us so that we can chew over all that we've learned today and prepare for the next class. The next class promises to be a fantastic one. It's going to build on certain things that we've learned from today's class, and our knowledge will increase on that and see how it's been applied in your exam and also in the real world. Thank you so much once again for attending this class. I want to wish you a good night's rest.